Okay, so previously we discussed about Section 27. Now we'll discuss about, it's still part of Section 27. Minimum Corporate Income Tax, or the MCIT. You remember, class, that domestic corporations are subjected to 30% flat rate. But there is this provision in paragraph E that uh, whenever they file an income tax return, they have to compare that with their minimum corporate income tax. That's 2% on gross income. Okay, so the idea here, if the minimum corporate income tax is less than or more than the normal income tax rate, then the minimum corporate income tax prevails. So say, for example, if the 30%, the product here is, say, 100,000. But then, if you multiply the gross income by 2%, the product or the result is, say, 500,000. Then, the corporation shall pay 500,000 tax. The idea here is that it starts on the 4th year immediately following its commencement of business. Okay? If the normal income tax is computed is less than the MCIT. There's this interesting case, class, about PAL. Is CIR versus PAL, GR number 180066. The PAL, as you know, there is this franchise of PAL, which is wherein it is required to pay 2% of its gross income as franchise tax in lieu of other taxes proviso, whichever is lower. So PAL has a choice. The PAL has to pay 2% of its gross income as franchise tax, or the normal income tax, whichever is lower. It was given a preferential privilege. Now, but the BIR wanted to impose MCIT on PAL because in this case, PAL reported zero income. So 0 times 30% equals zero liability, right? So under the principle of MCIT, if the normal income tax is lower than the MCIT, which obviously what happened in this case, MCIT prevails. So you could only imagine MCIT 2% times the gross income of PAL at the time. So obviously MCIT is higher. So the BIR said, you have to pay because MCIT is different from the normal, or it's just the same with the normal income tax as provided in Section 27. That is the substitution theory which the Supreme Court rejected. It went on to say, or it went on to distinguish MCIT from the normal income tax. Now, here you go. In comparison, the 2% MCIT under Section 27 of the NIRC shall be based on the gross income of the domestic corporation. The court notes that gross income as the basis for MCIT is given a special definition under Section 27E(4) of the NIRC, different from the general one under Section 32 of the same code. So let's go there. E4. Gross income defined for purposes of applying the minimum corporate income tax provided under subsection E hereof. The term gross income shall mean gross sales less sales returns, discounts, and allowances and cost of goods sold. Whereas in Section 32, gross income in Section 32 is, except when otherwise provided in this title, gross income means all income derived from whatever source, including but not limited to the following items. So we'll go to this later, but for purposes of the discussion, here's what the Supreme Court has to say. According to the last paragraph of Section 27E(4) of the NIRC, gross income of a domestic corporation engaged in the sale of service means gross receipts, sales less sales returns, allowances, discounts, and cost of services. Cost of services refers to all direct costs, etc., etc. Noticeably, inclusions in and exclusions deductions from gross income for MCIT purposes are limited to those directly arising from the conduct of the taxpayer's business. It is thus more limited than the gross income used in the computation of basic corporate income tax. The court herein treats MCIT in much the same way. Although both are income taxes, the MCIT is different from the basic corporate income tax, not just in rates but also in the basis for their computation. Not being covered by Section 13 of Presidential Decree number 1590, which makes PAL liable only for basic corporate income tax, then MCIT is included in all other taxes from which PAL is exempted. You remember the in lieu of all other tax proviso. So, in the case of PAL, the PAL's franchise is that it has to pay 2% of its gross income as franchise tax in lieu of all other taxes, or the normal income tax, whichever is lower. Such that the court said in this case that the MCIT is included in the other taxes, which PAL is not liable to pay. The substitution theory, as rejected by the Supreme Court in this case, is not applicable. Okay, you should have a good grasp of that distinction by now. MCIT has a different rate and its base of computation is different from the normal income tax. Okay? Okay. So, just remember, MCIT, as discussed in the case of PAL, is different from the normal income tax or the basic corporate income tax rate. So, that's about it for Section 27E. Next, we will discuss Section 28.